Good evening, everyone. Welcome to the DIG webinar titled Real Estate Market Trends 2017. My name is Don Brown. I'll be your moderator tonight, and our presenter is Vina Cox-Jones, otherwise known as the Real Estate Goddess. She's quite an expert in this area, and we're honored to have her with us tonight. Let me take a couple minutes just to introduce what we're doing, and then we will turn the evening over to Vina. And to introduce her, you may have all read this in your email notices, but Vina has been a full-time real estate investor since 1989. That's quite a while. And she's wholesaled over 600 properties and has written a lot about the subject. She's been the past president of the National Real Estate Investors Group and has appeared in Money Magazine, Reader's Digest, and many other national publications. Okay, so that's our presenter. That's the short version of her biography. I have a longer version, which I'm not going to read, but it's all on her website. So a few housekeeping notices, a few housekeeping notes. This webinar is being recorded, which means we will be able to post it up on the DIG website in a few days in the protected member section. And if you don't know how to get to that section, let me or other folks at DIG, or ask me or other folks at DIG.
Hello, everybody. I'm Vina Jones-Cox. I am talking to you tonight from a hotel room in Jacksonville, where I was at a mastermind meeting today, and we're going to talk about the state of the market. I looked at the questions that you guys had put in on the GoToWebinar panel when you registered. Don had put up a question that said, "What do you want to learn tonight?" And a lot of people said something about, "I want to learn how to wholesale properties. I want to learn how to flip houses." And I am absolutely going to teach you that, but not tonight. That is going to be on March the 30th at the DIG meeting. What they asked me to speak about tonight was a little bit more along the lines of just what is going on in the real estate market, and I'm going to touch a little bit on how wholesaling fits in with that toward the end. But you know, it'd be silly for you guys to be on a webinar tonight and we talk about wholesaling for 45 minutes, and then I come on the 30th and we talk about it for another hour and a half. So just be aware that tonight's topic really is more applicable to the whole real estate market than it is just to wholesaling. And it's important because wholesalers are kind of the canary in the coal mine in terms of what is going on in the bigger market, because everything that affects the bigger market affects our customers as wholesalers. You know, our customers are other investors, so they're rehabbers, they're landlords. So if rents are going down, it affects what our landlords want to pay for our properties that we're wholesaling them. If demand goes up, it affects what retailers are willing to pay for the property. So it is something that as a wholesaler you need to be very cognizant of, and that is, you know, what is happening in the market. So tonight we're going to talk about what is up in the Philadelphia market specifically, and what is going to happen next, at least in my opinion. We're going to talk about market cycles in general, because we are always in one, I guess, but we're at a specific place in the market cycle right now that has some people running scared. It seems like every place I go, including this mastermind group I was in today, people are saying, "Oh, real estate bubble, houses in my market have gone up a lot, and there has to be a real estate bubble." And I actually disagree with that, because when you understand the bigger market cycle, I just don't think we're there yet. Now we could be in a little, we could be up for a mini cycle this year, but I'll explain more about that when we get to the market cycle. And then again, I'm going to touch a little bit on why understanding how to wholesale is a really good thing to do in the part of the market cycle that we're in right now. Don actually did a really great job introducing me. I'm not going to spend a bunch of time on this slide. You know, I have been a full-time real estate investor since 1989, which was actually, as it turns out, the tail end of a market cycle. I've been through another full one since then, and now we're about getting to be between 8 and 10 years into the next cycle. I've done over 1,000 real estate deals in my career, and I am still actively in the business. I've done four deals in the last 10 days, so this is as important to me as it is to you, because this is how I make my living, is understanding what people are looking for in terms of properties in my area. I am the past president of National REIA, as Don mentioned, and also of the Ohio Real Estate Investors Association and the Real Estate Investors Association of Greater Cincinnati. I also founded a group in Columbus a few years back. I am a licensed real estate broker. So for those of you who are agents, I am as well. And, you know, I'm really proud of the fact that I actually got through the 1989 to 2006 real estate cycle and am still in business, because I know a lot of people are not. So let's talk first about Philadelphia. It's funny how every investor in every market seems to think that their market is more or less unique, and that what is happening there, which is rising prices and falling inventory, is somehow different than it is every place else in the country. But it's not. Philadelphia's price recovery line looks about like everybody else's. You had a really good year last year. It was a warm market, not a hot market. The hot markets like San Francisco and Nashville and Phoenix and places like that actually experienced double-digit growth in 2017 or in 2016, and they are in a little bit more of a bubbly type market. Philadelphia is more of a warm market than a hot market, and it did, in terms of at least rising prices, slow down some at the end of 2016. So overall, the prices of sold properties went up about 9.4%, but in the last quarter of 2016, they only went up about 3.5%. And Zillow, at least, is only predicting a 3.2% growth rate in prices this upcoming year. Rents are up quite a bit more than house prices are, which is a piece of data to tuck into the back of your brain for a minute, because if you're going to talk about properties starting to be overpriced, you have to ask the question, overpriced relative to what? What drives house prices? And the answer for certain categories of property, your bread and butter houses, your move-up houses, is that demand that drives prices. But for your rental houses, it is the rents that drive the prices. So in other words, it's income. If I'm going to invest a certain amount of money in a rental property, am I going to get an income that compensates me for the risk and time and effort and money that I'm putting into the deal? And when you look at the growth in rent versus the growth in house prices, rent has actually gone up quite a bit more than house prices have. It is up over 12% since 2014, but that number is also slowing, because in the last 12 months, prices, rents, and this is median rent, so you got to take all these numbers with a little bit of a grain of salt, because you could break this down and say, how have rents on one-bedroom apartments changed? How have rents on three-bedroom houses changed? And this is kind of a median of all rents, but they are way up. And vacancy rates are way down, but the increase in rents slowed last year to where they only went up about 1% last year, and vacancies are actually slightly up year over year. But overall, the rental market is incredibly strong in the Philadelphia area. Now, what everybody really cares about, because it's the thing that's affecting us most as real estate entrepreneurs, is inventory. Inventory is at a historic low. There are fewer houses listed in MLS right now than there have been since they started keeping track. I mean, it is not your imagination. There are not very many properties on the market, especially not relative to the demand. And yes, they go very, very quickly and for too much money. Inventory has been dropping every year since 2012. And last year it dropped again by another 14%. Days on market is down to 87, which, I mean, you might be sitting there thinking, oh, no, that's not right. Our houses go off the market in 2 days. No, they go pending in 2 days. It takes 87 days to close, but most of that time is actually in the process of people getting loans. So days on the market is down 13% year over year. There was a little bit of a rise in inventory in the last month, but that, of course, was because it's winter. Things do slow down every winter. If you look at this as an overall graph, every winter things go down, and every spring they go back up again. So the 2% month over month thing isn't. I wouldn't call that the beginning of a trend. I think you'll see inventory down again come April. So this is the biggie, is inventory. You do need to keep in mind that when you hear these inventory numbers and the news just seems to be getting worse and worse and worse for us as buyers, it's great if you're a seller, but for us as buyers, like every new piece of news we see about inventory, there's less of it, and it's going faster, and it's going for more money. When the National Association of Realtors talks about inventory, and that's where this graph came from, by the way. The other ones came from Zillow, but this one came from the NAR. When they talk about inventory, they're talking about listed inventory. They're not talking about every single person who might want to sell a house who maybe has not listed or did list it and it didn't work. It's only listed inventory, and you cannot let the fact that your agent can't find you a deal that you can get at a price that you want to pay exclude you from the market. Because if you do that, then that'll happen every time we've got a seller's market, which is half the time. Half the time we have a seller's market. The trick is you need to learn to find off-market deals. And as an aside, I'm there in Philly on the 30th of March. I'm back again on the 8th of April doing an all-day meeting, and that's a Saturday. And the second half of that all-day is going to be about how to find off-market deals. So if like most people, what you're seeing on the screen right now is the most important thing to you, make sure you are there on April 8th. So in kind of a summary, the median house value in the city of Philadelphia, so this is within the city limits, and these numbers, you can Google these numbers, and they're going to change a little bit depending on who you're asking, because sometimes the numbers include new construction, sometimes they exclude new construction, but roughly the median house value in the city is about $135. If you take the whole metropolitan area, so now you're in that bigger area, that map you saw there that includes kind of the southeast part of New Jersey and or southwest part of New Jersey and so on, is about $165.9. The U.S. median house value is $201. So Philadelphia still has very affordable housing, which is what attracts people from New York City to come down there and buy turnkey rentals, because they can't touch anything for anything close to your median house values. The average rent inside the city is $1,210. In the metro area, it's $1,589. That is a lot of rent. I mean, compared to what the United, in the whole United States, it's even high compared to the whole United States. In Philadelphia, on average, people right now are paying about 43% of their income in rent. And that is a big number. It's a bigger number than the Department of Housing and Urban Development recommends that, they really want people paying 33 to 35% of their income in rent, and in Philadelphia they're paying 43%. So that's a number that, again, you gotta stick it in your brain and say, what does that mean about where the market is going to go? And I think something that it means is that people who should be buying houses because it would be cheaper for them to buy than it is for them to rent are not buying because of the lack of inventory. I think there's probably a lot of people who've done this math for themselves, and they're saying, good Lord, at the interest rates we have today, I could own a house for half that much money, which would give me plenty of money to do the, maintenance on the house and so on, but I just can't get a property. So that tells me that there's probably a lot of pent-up demand that can't get met right now because of the inventory issue. So let's fit Philadelphia into the bigger picture of the real estate market, because there is a pretty proven real estate cycle that goes on not just in the United States but in all industrial countries that have what we would call modern banking systems, where it is typical that the way people buy houses is there's some sort of accepted loan program out there. In the United States, it is 30-year loans, fixed rate for our homeowners anyway, and you'll find the same exact cycle in Australia and Canada and Great Britain. Now, they are sometimes on different cycles, so it's not that if our cycle is going to peak in 2022 that it's also going to peak in Australia and Great Britain and Canada in 2022. That's not the case. But this is a thing. I mean, if you Google 18-year real estate cycle, the first guy who wrote about it in the early 1800s, and the guy who did the math to sort of prove it did that in the 1970s. And what the real proof in the pudding there was that back in 2003, another guy applied it to the real estate market and predicted the crash in 2008 using the 18-year real estate cycle. And it's pretty much, give or take 6 months or a year, it's an 18-year cycle. And the only time that we have not had the full cycle in the past 100+ years was right after World War II. We were due for a bust around 1947 or 1948, and it did not happen because we had, hundreds of thousands of soldiers coming back from overseas who wanted houses. So we didn't have the real estate bust, but it reset itself in the 1960s, and it's been pretty consistent ever since then. So there are 4 phases to this cycle, and you can put them in any order you want, I guess. But the first phase is recovery. Now, there's something important about this slide that I want you to understand. You're going to see this line go up, and then you're going to see it peak, and you're going to see it come down. That line does not represent house prices. It represents occupancy. And there is a long-term occupancy average that if you took all real estate across all time and said what percentage of that real estate would typically be vacant. So like a number that we use in apartments is, an 8 to 10% vacancy rate, right? That would be typical. Well, that's clearly not, it's not that all the time your single-family homes are going to be 10% vacant. Right now, they should be a lot less than 10% vacant because we have extraordinarily low vacancy rates. When vacancy rates start to go up, that's when this line goes up. All right, so this line is the long-term occupancy average. So in the recovery phase, the way you know you're in the recovery phase is that there is very little new construction going on, if any. Builders are not putting up houses and they're not putting up apartment buildings. prices fall to below an average rent-to-value ratio. So what is that? Well, those of you who've been around a while, remember that there was a time back around 2000 to 2005, let's say, where people thought of rental houses as being worth 1%, or I'm sorry, the rent was 1% of the value, right? So if you had a $750 a month rental, that house was roughly a $75,000 house, if you guys remember that. That was the average rent-to-value ratio. So people were basically buying houses at 100 times the gross rent per month. And when you're in the recovery phase, the prices fall below that. And you will also remember that post-2008, that happened in our markets, right? A house that rented for $750 was no longer a $75,000 house. It was like a $40,000 house. So that's what I mean by the prices falling below the average rent-to-value ratio. You have much higher than normal vacancies, but in the recovery phase, they are starting to be absorbed. So if you remember, after the real estate market crashed, there were whole neighborhoods that you could drive through where it seemed like there were more vacant and boarded up properties than there were occupied properties. Remember that? That was during the recovery phase. But now if you go through those same exact neighborhoods, the boards have come off on the properties that haven't been torn down. The boards have come off, and those properties are under renovation or have been renovated, and people are living in them now, right? So we don't have higher than normal vacancies right now. Those have been absorbed, and we have lower than normal vacancies right now. In this phase, in this recovery phase, banks have extremely tight restrictions on real estate borrowing. It's hard to get a loan. Real estate is no longer a favorite asset class for banks to do loans on, and the reason is that they just came out of the crash phase, which we're going to describe as being the last phase, okay? Now, you might be sitting there thinking, well, what she just described, all she did was just describe 2009 to 2012. Yeah, well, I also just described 1986 to 1989, and I also just described 1971 to 1972. It's the same in every real estate cycle. And the reason that you have the same effect is because in every real estate cycle you have the same cause. Now, so let's get over to the part that's the crash. Phase 2 is the expansion phase. In phase 2, the occupancy rates exceed the long-term average. In other words, the vacancy rates decline. So occupancy rates higher equals vacancy rate lower, right? In the expansion phase, you start to get new construction. You see new construction in Philadelphia? At least in some asset classes. Are you seeing a lot of new construction in city apartments, for instance? Are you seeing new construction in move-up and luxury type property? Because you did not see that in 2009 and 2010. Prices rise during this phase, but this is really super important because this is going to tell you tell you when the bubble is coming. You ready? Prices rise, but the prices are being driven by the users of the real estate. They're being driven by the fundamentals of supply and demand. The prices are going up because a lot of people want to live in houses and there aren't enough new houses for them to buy, so they're buying old houses, and that is pushing the price up. That's your homeowners, right? But for you and I, for people who are looking at these things more as investment properties, the price in rental properties is being driven by the return, by the fact that rents are higher. So when prices are going up, that doesn't necessarily signal a bubble as long as the fundamentals are strong. One of the things that happens in this expansion phase is that banks loosen up some, but private capital, so this is your hard money lenders, your private lenders, people like that, Wall Street, get drawn to real estate because there's a gap to be filled. The banks are still all, we're afraid of loans. You got to have an 800 credit score to get a loan. But people who are investing money for the purpose of making a profit, which is not what banks do anymore, they don't invest their own money. They sell their loans on the secondary market, blah, blah, blah. When they desert that business of loaning money to people and private capital sees an opening, they jump into it. Now, has that happened in the last few years? Absolutely. Look at the number of hard money lenders that belonged to DIG in 2009 and look at the number that belong now. Look at the hedge funds, the Wall Street hedge funds that have started doing long-term landlord loans. I mean, Blackstone has gotten into that business. Colony has gotten into that business. They are drawn in because the banks have left a gap that is profitable to fill. So I'm describing what? I'm describing 2012. For you guys, actually, your market didn't really bottom out until a little bit later than everybody else's. Yours really kind of bottomed out in 2013. But I would say this is still going on, wouldn't you? I would say we are still in the expansion phase. And the reason I say that is because we're clearly not in the next phase, which is hypersupply. Hypersupply happens when overbuilding happens. Bubbles don't occur because people are just like, tulip bulbs speculating, right? Oh, I'm just going to pay more for this house because the last person paid more or paid less, and I just think I can hold on to this house and it'll become more valuable magically like Beanie Babies, right? What drives bubbles is too much financing available. Financing is too easy. And for that reason, builders oversupply the market. And yes, speculators start coming into the market and buying properties that are going to be less and less in demand because there are going to be too many of them. And the thing that signals that we have entered the hypersupply phase is when the vacancy rates start increasing. And that has not happened yet. We do not have overbuilding. We do not have prices that are not being driven by the fundamentals. We don't have an easy institutional credit. We don't have increasing vacancy. We can see the signs that those things are coming. We can see the return of the 90% investor loan, and pretty soon we'll see the return of the no money down investor loan. They show my driver's license, and that's my application investor loan, but we are not there yet. Now, again, let me remind you that this line is not about price, it's about vacancy. Because in the hypersupply phase, prices continue to go up. I'm going to show you another chart showing you prices here in a moment. I just don't want you to get confused about what you're looking at. The thing that Vina is going to be looking for to tell when we are getting toward the end of hypersupply and about to crash is the foreclosure rate. Do you remember what happened to foreclosure rates starting in 2006? Because 2006 was really, the market turned in 2006. We just didn't feel it until 2008, because from 2006 to 2008, vacancies were going up drastically, foreclosure rates were going up drastically, but so prices continued to go up, which sounds like a weird combination of things. But when you understand that what was happening was the banks were making it so easy for people to borrow money that they were just going to go ahead and, go buy a house they couldn't afford because why not? It's easy. the foreclosure rate was kind of the death knell. Philadelphia foreclosure rates are lower than the national average right now, and they are lower this year than they were last year. So we do not have those increasing foreclosure rates yet, so we are not in hypersupply, and we are definitely not at the end of hypersupply. Why does foreclosure increase during hypersupply? It's because right now, if you go into foreclosure on your house and you make any attempt to sell it, if you put it on the market, it's probably going to sell, right? Because there's low supply. When you get into hypersupply and your house goes into foreclosure and you put it on the market, it doesn't sell because you've got a lot of other people trying to sell their houses at the same time. And why are they going to buy your foreclosure house when there's all these brand new properties to buy that builders are, starting to offer bigger and bigger incentives on? So the hypersupply phase in this last market kind of started around 2001. Prices continued to go up, though, and it wasn't until 2008 that the market actually crashed, and that's the fourth phase, which is recession. You have massive defaults on all that easy lending that happened in the prior phase. Builders go bankrupt, and they leave whole half-finished subdivisions for the banks to repossess. It takes a long time for the banks to get a grip on all of their REOs and get those worked through the system. You have extremely high vacancy rates, prices fall way down, and you have this extreme contraction of institutional financing because banks they don't want to take a risk on making those loans. So that was 2006 to 2009, give or take a year, depending on, maybe where you were in the country. So this is the phase that people are afraid we are approaching. I think the phase we are approaching is phase 3, which is hypersupply. I think we are still in expansion for right now, and that we could get into hypersupply. So I told you we would look at a graph that did, in fact, reflect prices. The first phase of this, which would have been the beginning of recovery to the start of hypersupply, is around 7 years. So if recovery started in 2011, 2012, somewhere in through there, and 7 years pass, that puts us in 2018 or 2019, not in 2017. You'll notice that there is a little blip here in the graph. So it goes price up, price up, price up, and then briefly, for like maybe 18 months, there is sometimes what is called a mid-cycle slowdown. That we are due for. If it is going to happen, it doesn't happen in every cycle, but if it's going to happen, it's probably going to happen this year or next year. Mid-cycle slowdowns are caused by something outside of the real estate market. The two things that I think could cause a mid-cycle slowdown for us are what caused it in 2001, which was a stock market crash. In 2001, the stock market crashed. It caused a mid-cycle slowdown in real estate. Prices dropped by, depending on where you were in the country, 2 to 10%. They stayed down for about 18 months, and then they bounced back. That was what happened in 2001. The other thing that can cause a mid-cycle slowdown, and it is caused the one in 1979, is government intervention in the finance market. Specifically, in 1979, the Fed doubled interest rates. And yes, that caused a slowdown in house prices when the Fed doubled interest rates. As you know, we had a price hike yesterday, a 0.25% increase in rates yesterday. The Fed has kind of signaled that they're going to take it up a full percent this year. 1% is probably not enough to cause a mid-cycle slowdown. A stock market crash would be enough to cause a mid-cycle slowdown, but you have to ask yourself, is a mid-cycle slowdown a good thing for me or a bad thing for me? Personally, I'm looking forward to it because I didn't buy enough houses during the recovery. I should have bought more houses than I did when prices were low. and I am looking forward to them dropping some so that I can get in and snatch some more up in preparation for this next part, which is the hyper supply, which typically lasts about another 7 years, and then, or sorry, another 7 years, and then you've got the crash and the recovery, which takes about 4 years. So in my humble opinion, of course nobody really knows this stuff, we are getting toward the top of the expansion. We could be looking at a mid-cycle slowdown this year or next year, and the next peak followed by the crash would not be due until 2022 or 2024. So that is how I am planning my life. I feel ready now for the next crash because I've been through the last one, and it's really not something to be afraid of, because there are opportunities in every part of this cycle. You just sort of have to know where you are and be doing the right thing. So in the expansion phase, the right thing is understand that the fundamentals are still strong. You don't need to be afraid of rising prices because the properties are not overpriced based on their income potential. Now, I'm talking about, I'm not saying you can't go out and buy an overpriced property. Of course, you can go out and buy an overpriced property, but in general, the median prices are not too high for what properties will bring in for you. Institutional financing is getting looser, but it's still more restrictive than it probably ought to be. The pendulum always swings way too far in the other direction. It's like the banks can never get it quite right, and the builders can never get it quite right. The builders are either underbuilding, which is what they're doing right now, or they're overbuilding, and the banks are either underlending, which they are right now, or they're overlending. And that's what causes the real estate cycle. So there is a lot of private money available, Wall Street money, hedge fund money, hard money available. It is a safe market for the real estate investor who is educated about this stuff. Okay, if you don't know how to come up with the value of a house, it is never a safe market for you. I don't care if the market's up, down, sideways. If you don't have your education in place, it's not a safe market. But if you do, the market right now is actually pretty safe. And the reason I'm pretty sure it's not going to crash soon is, again, the demand is being driven by the users, not the speculators. Financing is not overly easy to get. You know, I knew there was something wrong back in 2004 when this couple applied to rent a house, and I turned them down because they were not qualified renters. And about 3 months later, I had a house for sale in the same area. And this same couple showed up and wrote me a purchase contract on the house. And I said, you can't, there's no way you're going to qualify for a loan. I mean, the house up the street that I was going to rent you, I wouldn't rent you. And they said, oh, no, we've got a pre-qualification. And they, by God, closed that house. Like the bank was less interested in getting paid than Vino was interested in getting paid, and I knew that was a problem. But of course, no, I don't think anybody quite realized that the American financial system was going to drag down the whole world in regards to subprime mortgages. Anyway, prices are driven by lack of inventory right now. They are not being driven by the fact that money is too easy to get, which would be a sign that we were about to crash. And in most markets, there's just no overbuilding. Now, little grain of salt with that. I am hearing about bubbles in certain kinds of property. I was just down in South Florida, and everybody in that real estate association is talking about how condos in the $300,000 plus price range are overbuilt. They are still building them, and they've gotten really, really hard to sell. So I would say that South Florida is experiencing an over $300,000 condo bubble, but the rest of their properties are not overpriced, and they're still moving very quickly. So, which, by the way, that story I just told you is why you belong to Dig, so that you can hear things like that from local folks who are in the market every day. Now, I'm going to answer some questions in a couple of minutes, but just a couple of practical things I want to point out to you. First of all, everything we just talked about does not matter if you are not prepared to take advantage of whatever market we are in at the moment. So you have to ask yourself if you personally, you individually, have put yourself in a place where you actually know how to evaluate opportunities that come to you. If you don't know how to figure out the after-repair value of a property and what it will rent for and what the repair costs are, it doesn't matter if you're tripping over great deals, you're not going to recognize them. Do you have the education in place to pull the trigger when a deal shows up? Like, can you be relatively confident that, hey, if I write an offer on this property, it's going to be a good offer? Do you know at least one exit strategy? So in other words, if you find a great deal, do you know what to do with it? And do you know what's profitable to do right now? There are some things that will absolutely stop you from being in that position and really make it hard for you to get into that position. And these are more, again, this doesn't have to do with the market, this has to do with you. One of those things is if you have a lot of personal debt and financial chaos going on in your life. Financial chaos meaning you're only able to make the minimum payments on your credit cards. You have a lot of outstanding personal debt, whether that is student loans, car loans, credit card debt, whatever the case may be. Financial chaos is you don't have any health insurance, or you don't have 6 months worth of living expenses in reserve. You know, those are all things that grown-ups have, right? So if you have a lot of financial chaos, it's difficult for you to get in a headspace where you can think about developing financial independence, because right now it's just such a day-to-day thing about, am I going to be able to pay my bill? If you do not have opportunities being presented to you, so you know what an opportunity looks like, but they're not showing up in your life, that is going to be a problem for you in the market right now. Not having your basic skills and knowledge in place about evaluation and negotiation is a problem. Not being connected with the right people, and I don't mean the mayor and the head of the building department, I mean being connected with people who can sell you deals if that's what you're looking for, buy deals from you if that's what you're looking for, close deals, right? Your vendors, your attorney, your CPA, all of those, your real estate agent. You got to know those people, and they need to be investor-friendly people. And again, that's why you pay the dues to dig, is because they hook you up with the right people in terms of who's going to support your business. I'm gonna say that if any of that sounded familiar to you, if you've got some financial chaos going on in your life, you really need to, as your first strategy, flip something. Now, as it happens, I have a favorite thing to flip. My favorite thing to flip is ugly houses, and of course that is called wholesaling, and it's the topic of the meeting on March the 30th that I hope you guys will all come to. There are other things that you can flip, okay? I like ugly houses because there are a lot of them. There's a lot of demand for them in the market right now in particular. It's an asset class that I'm very comfortable with. I like dealing with sellers of ugly houses because they know they have a problem and I can fix it for them. You can also flip pretty houses. You know, there's such a thing as a lease option assignment. You could flip notes. But if financial chaos is a thing in your life, forget all of the other stuff. I like the other stuff. I own rentals. I do lease options. But if you need to get your financial house in order, don't think about that stuff until you have flipped enough things to create cash to get your financial house in order. The advantages of flipping, it requires you to have very little money. I mean, you got to spend some money on education. It's not something you're going to go figure out on your own, at least not if you're smart. but you don't have to have money to buy houses, because typically what you do is you put the properties under contract and then you sell the contract. Your credit doesn't matter when you're flipping because you're not getting loans to buy houses. It's fast, and fast is important if you're trying to resolve some financial payoff issues. And then the best part to me, because guys, I've been in that position. I've been in that, when I graduated from college, between my fiance and I, we had, at the time it seemed like an unwieldy number. It was $45,000, but that just seemed like all the money in the world at the time, in student loans, car loans, credit card debt, all of that sort of thing. So I know the psychology that goes, I really, really, really need to do something, but I'm so stressed out by paying my bills this month that I'm having a hard time. You think the more desperate you get, like the more you'd be on it. It's the other way around. The more desperate you get, the harder it is to follow through with things. And the good thing about quick flipping, about wholesaling in particular, is you don't have to deal with money, deal with contractors, deal with tenants, all of that sort of stuff. So it's a much simpler strategy than a lot of the other things that you might be considering or have heard about. And of course, the big thing is it generates cash. So get rid of the debt, put some money in reserves, have some money to go invest in the next level, which is the passive income level. Those are all big advantages of quick flipping. Now, there are downsides. It is something you are going to have to put effort into. There's not, well, until you build a business, which is our other topic on April 8th, we're going to talk about how to build a wholesale business. It's kind of you going out and finding the deals and talking to the sellers and putting in your time. Now, it's very highly paid time. Like if you're doing this right, you're going to make $1,000 an hour, and I'm not exaggerating when I say that. You're going to make $1,000 an hour for the time that you spend. But unlike your passive investments, you don't just sit back and a check comes in. And also, unlike your passive investment, once you've sold a wholesale deal, your next job is go and find the next wholesale deal. You're always looking for the next deal. It's not a passive business. It's not a tax-advantaged business. It doesn't provide ongoing income the way rental properties or like notes and stuff do. So I told you the pros and the cons. If this is a strategy that you need to do, you probably know it. So let me just walk you through one of my recent deals, give you an example of kind of how this works. This little house is a rental property. It was being sold by a landlord he's just kind of decided he doesn't want rental properties anymore. And he called us up from a mailing that I did, and I'll share what that mailing was on April the 8th when we do our all day on Saturday. And he called up and he said, I'm a landlord too. I know you got to make money. I get it. This house needs work. As a matter of fact, Section 8 didn't pay my rent this month because they came and put a bunch of orders on it, and I don't want to do them, so I will make you a great deal on it. I put the property under contract on a Friday for $20,000. So on Friday, he and I signed an agreement that said, you will sell, I will buy, the price will be $20,000. On Friday afternoon, I sent out an email to my list of people who have raised their hands and said, I'd like to know about good deals that you might have. And the following Wednesday, I got a check for $5,000 from one of those buyers, who then went and closed the deal with my seller. That wasn't the end of that story, because remember I said he had a few properties, and whenever a seller says that, I've got a few properties I want to get rid of, you say, well, tell me about all of them. Same seller had this house for sale. That one I put under contract for $32,000, and am assigning this contract for $17,900. So that one phone call from that seller was worth over $22,000 to me. And you got to think about, if I got some stuff I need to do monetarily, I've got bills to pay, I've got credit cards to pay off, I've got a car to pay off, I've got student loans to pay off, so that I just don't have to worry about them anymore. How far would $22,000 go to do that? And you're not going to make $22,000 on every deal, and you probably aren't going to make $22,000 on your very first deal. But even if it was only the 5, would that help? And would it help to be able to do it over and over and over and over again? You need to flip houses. You know, I got to ask you the question, you know, why aren't you flipping houses? And I think that your answer is going to be something along the lines of, I don't know how to find the deals, or I don't know how to find the money, or, you know, something along those lines. And that is why you need to come to the DIG meeting. And we're going to answer questions in just a minute, on March 30th at the regular Thursday night meeting, I'm doing a 90-minute presentation called 30 Days to 10K. How to wholesale in 2017, and what we're going to do at that meeting is I'm going to walk you through the process of flipping a deal. Who's the buyer, who's the seller, what's the property, what neighborhood should I be looking in, how do I figure out what to offer, what's the paperwork, okay? On April the 8th, we're doing the all-day session. Morning will be how to build a wholesaling business. Afternoon will be how to get your phone ringing off the hook with motivated sellers. They're not duplications of each other. You need to come on the 30th, and you need to come on the 8th. The thing about the 8th is, I understand there's limited space in that workshop. Also, apparently, I looked on the website today, and the price doubles if you don't pre-register. So if you want to make sure you've grabbed a seat in that, I made a bit.ly link. It's bit.ly/digvina, exactly. It's a really long, I mean, you can just go to the DIG website and find it, but it's a really, really, really long memorized link. So if you just go in and put in bit.ly.com/digvina the way you see it there, it'll take you straight to that registration page. And it's $50 for pre-registered members and $100, I think, if you wait. So, and I get 0 of that. So I'm not telling you this for my good. I'm telling you this for your good. Go register for that. All right, Don, do we have some questions that I can answer? I don't know why I put on my glasses. I can't see the question.
Okay, let's see. There's a couple questions that I put on your screen already. And there's a new one that just came in, which I will forward over to you.
All right. Am I looking for the chat box? Is that what I'm?
And ladies and gentlemen, now's the time you can ask your questions or type your questions in the box.
All right. Can you hear Vina? Okay. So somebody asked. I can't see who asked because I'm only seeing Don's name. How long do you think this bull market will last? What will be the warning signs of the downturn? I think I got that. I think I hit that, right? I think if we're talking about the real estate bull market as opposed to the stock market bull market, which I'm not an expert in the stock market, definitely, but I can tell you it's starting to scare me.
Yeah, the person who asked that question just commented that you've answered it. Thanks, Cliff.
Okay. All right. Going forward, should we flip, meaning buy, fix, sell, or buy and hold, given where we are in the cycle? I think it's still... for right now, I would say both. There's a very high demand for first-time home buyers looking for properties, move-up home buyers looking for properties. So if you can find the deals that you can buy at a price where you can profitably flip them, you're good, right? I mean, there's lots of people who want those. I think you're still safe to buy and hold as long as you're buying right. You don't go out and pay full price for properties. If there is a mid-cycle slowdown, fingers crossed, buy some stuff that you're planning on sitting on for 18 months to 2 years, even if you don't want to own it long term, because if prices go down, then they will go back up again. When the market goes insane, the way it did from 2004 to 2008 or so, stop buying to hold. I have 3 or 4 houses that I wished that I could have given back to the bank and then bought back at their new value in 2009, and every single one of those houses had something in common, which was I bought them in 2005 or 6. And I was buying them at 70 cents on the dollar. I thought, I know the market's going to go down, but it's not going to go down more than 30%. Wrong. So at that point, when there's a lot of stupid money in the market, people are just paying way too much for houses. What you want to do is wholesale. If there's a gold rush, sell picks and shovels. Don't acquire anything during those last couple of years. I mean, you can flip houses, just don't get. I mean, you can buy, fix, and sell. Just don't get stuck with anything, because that was the downfall of a lot of people. Was when the market crashed and there was no more financing available for their buyers, they were sitting on 12 or 15 finished properties with hard money loans that they couldn't sell. Let's see. Given the figures and trends you shared for the Philadelphia market, could they apply 60 miles north to the Lehigh Valley market of eastern Pennsylvania, including Allentown, Bethlehem, and Easton, or Northampton and Lehigh counties? I would have to do some more research before I could intelligently answer that question. I think that part of Pennsylvania is a little bit more depressed than the Philly area. I think it's akin to saying, can you apply Columbus numbers to Akron, Ohio? So my initial reaction is to say you probably can't apply them one for one, but I'm not going to sit here and lie to you and tell you that I know that for sure. Do you think the baby boomers and or millennials will impact the current real estate cycle? Wow, that's a huge question. Let me say this. I think the trend predictors are wrong about millennials. They're all saying millennials are not going to buy. We've moved into a renter culture, blah, blah, blah. I don't believe that. I think they are delaying buying. And I think that they are delaying buying for two huge reasons. One is the college-educated ones are coming out of school with such a gigantic student loan burden that they can't do what people did 20 years ago and buy, get married in their mid-20s and buy properties in their late 20s. I think they're going to wait until their 30s, which they're hitting now. The other reason is I think from my contact with millennials that they have a little bit of the same kind of thing that our parents and grandparents had having gone through the Depression. They've got a little bit of ingrown subconscious fear from having seen their parents go from living in the 4,000 square foot dream house with the 2 jet skis and the 2 cars to losing their house and living in a rental very quickly. I don't see how that could not have affected them since it happened to them in their teen years. So I think they're going to be more conservative about house buying than the prior generation was. I think they're going to buy houses they can afford. I think they're going to stay in their starter homes longer, but I think they will buy. Baby boomers are a different story. Everyone, for 20 years I've been hearing how when we hit this period in American history that all new houses were going to have to be single-story ranch houses because 10,000 baby boomers a day were going to be retiring, and the boomers have not acted like they were supposed to act. They are not retiring at 65. They are not moving into old folks' home. They're not dying, right? They're living longer and longer. They're waiting longer until they retire. So I think the boomers are gonna surprise all of everybody who was trying to predict that trend for the last 20 years. I don't know which way they will go, but I think it's going to be different than they think. You mentioned that different areas move in the cycle differently, Philadelphia versus South Florida. So where are the best locations right now in the U.S. based on their positions in the cycle? The best place in the U.S. to invest is in your backyard. Have you not met people who've invested in Philadelphia from out of town and talked to them about whether they had wished they had not done that or not? There's not, the grass is greener syndrome is a bad thing. If I lived in San Francisco, actually right now Seattle is the most expensive market in the country, I would be wholesaling and rehabbing because there is huge money in those areas and no money in renting. If I lived in Youngstown, Ohio, God forbid, sorry, Youngstown, where the median house price is like, I kid you not, $90,000. You can buy a pretty good fixed-up house in an owner-occupied area for between $90,000 and $110,000. There'd be no way I would retail houses because there wouldn't be enough profit in it. it's not about there's opportunities where you live, and real estate is not the stock market. You need to be able to put your hands on it and see it and be able to drive by it and manage your manager and all of those sorts of things, and you need to be doing that in Philadelphia. Philadelphia is one of the best markets in the country as far as I'm concerned. Is the 18-year cycle different for residential versus commercial? Yeah, it is, and the common wisdom is that commercial lags residential by 3 to 4 years. Now, I'm not a commercial property expert, so I'm just repeating something that I have heard, and I'm sure that you can go do research on that, but there is a lag time between what happens in residential and what happens in commercial. You mentioned the response to your mailing is the way you uncover your latest deal. Is direct mailing the primary way you find prospects for wholesaling? Yes, it is. As a part-time real estate investor, it is right now my only means of finding deals, and while I'm just getting started, I'm curious about how successful it has been versus other marketing outreach. Okay, if God spoke to me right now and said, Vina, you may only use one way of reaching out to prospective sellers, pick one, I would say direct mail. I wouldn't even sit there and go, should I keep my internet site? Should I keep my car sign? Should I keep my banner signs? It would be, nope, direct mail. And there's a variety of like logical reasons for that I will share with you on April the 8th. But I would say direct mail, yes. I don't want to wholesale properties, but I want to buy from wholesalers. I can't get them to even call me back. Wait a minute, are you telling me that you've got wholesalers who have deals and they won't call you back? Or are you telling me people who've said, I'm a wholesaler, call me up, is not calling you back? Because that second one, I totally believe, because there are easily 25 times as many people in the market who are trying to wholesale as there are who are actually wholesaling. And the reason I say trying to wholesale is not because they're like making a real effort and it's not working. It's because they don't even know how to make a real effort. They watched a webinar on wholesaling and it sounded so easy that they figured they could just go out and put stuff under contract and then somebody would pay them more. They literally, they think that's what wholesaling is. And they just never have anything under contract. So the reason they're not calling you back is they don't have a deal. If you got people who actually are advertising deals and they're not getting back to you, I would need to know more about that, because that would be very unusual. Is Robert Campbell the real estate forecaster to whom you were referring? That is one of them. Yes. If you look at this, if you look at the history of this 18-year cycle, it's a very long and storied history, but Robert Campbell is kind of the one who put it all together at the end there. I can only afford to assign contracts in Philadelphia. One, would I have to get the seller a deposit to take me seriously? And two, what happens if the newbie can't find an investor or buyer to flip the contract to? If you are dealing with, can you tell I can't quite figure out where the camera is in my computer, and then I'm looking all over the place for it and I can't find it. I'm trying to look at you guys, but I can't figure out where the camera is.
It's fine. I can see you just fine.
Okay. I'm distracting myself though. If you're working with sellers who have off-market properties, which is literally 98% of what I'm doing right now, because the on-market properties you can't get at a price that makes sense for wholesaling, they don't care about earnest money deposits. Agents care, banks care, sellers don't care. So no, you're not going to have to give them some big old deposit. You might want to give them $5 just so they feel like it's a nice legal contract. The second thing is, you are never going to put yourself in a position where you must buy the house if you can't find a buyer, because that's what contract contingencies are for, and I'm going to talk more about that on Thursday the 30th. If you have a wholesale deal under contract and you cannot sell it, in this market, you did something wrong. And I promise you what you did wrong was the evaluation. You're trying to sell it for too much, and you're doing that either because you did not know what it was worth fixed up, or you didn't know what it was going to cost to fix it. And we're going to talk about that on Thursday too. You can't not know those things and do this business. What do you think about expired listings in MLS? Are they good prospect for buying at lower prices? I do market to expired listings, but my experience right now is that the reason they expired is that the seller needs to get too much for the property. If it was priced right, or if the seller could take a reasonable offer, it would have sold. So what I am finding from expired listings is not wholesale deals. It is like subject to lease option type deals. Could you provide references for the data you used tonight? All of the graphs on the first 4 or 5 slides about Philadelphia were from Zillow. The one that was talking about days on market was from Realtor.com. The 18-year real estate cycle slide, that was actually who published that was actually at the bottom of it. It's Ascent. I think it's AscentInvesting.com. I liked their graph and I didn't want to reproduce it. Follow-up from the wholesaler's question, how do you get the attention of wholesalers who actually have deals? You pay them. You know what gets my attention? Money. And a wholesaler's job is to make it easier for you to buy. Like they should have a good deal tied up, really tied up, under contract correctly. They should know what the paperwork is. They should make it easy for you to access it. They shouldn't tell you that you need to go do your own numbers because they haven't been inside the house. That's their job. Your job is not to be a pain in the butt. I will only sell to people who have done deals before because they understand the process. And when I sell to newbies, they want to bring in their brother-in-law to come look at the property after they've already looked at it, and they want to get their realtor in there, and and that's fine. If that's the due diligence you need to do, you should not buy it. If you need to do that due diligence, you should not buy a house without doing it. At the same time, as a wholesaler, I'm working on velocity. So chances are by the time you have done all of the due diligence you want to do, I've already sold the property. I'm not holding it for you because you need to get 19 people in there to take a look at it. So try to not be a pain in the butt would be my recommendation if you want to get wholesalers' attention, and pay them. If we have any questions after the webinar, how do we reach you? Oh, that's an awkward question. Dawn, are you okay with me giving them contact information, or do you just want them to come talk to me at the March 30th meeting?
Whatever you're comfortable with. If you would like all the queries to come through me and then I forward them to you, that's okay too. Whatever you're comfortable with.
I'm okay with giving my contact information. I just wanted to make sure you were.
Yeah, sure.
Okay, so my website is regoddess.com, like realestategoddess.com, and there's a contact us form there on the page. So if you have any follow-up questions, that'll initially go to my assistant, and if she can answer it, she will, and if not, she will send it to me. Are you saying pay them just to call you back? No, that's not what I'm saying. Okay, again, if you've got a wholesaler who is advertising a deal and not getting back to you, there is something going on there. It's a fairly common thing right now for, let's say, Don wouldn't do this, but I'm just going to use him as an example. Let's say that Don is trying to break into wholesaling, and he has taken some webinar from some amateur who's never actually done a wholesale deal, and that amateur said, hey, the way to build your buyer's list is go find other wholesale deals that other people have, and then you advertise that deal to people as if it were your deal. And that way you can build your buyer's list. Well, there's a ton of things wrong with that statement. Number one, Don is actually breaking the law by advertising a deal that he doesn't have under contract. And number two, he's alienating good buyers, because if I contact Don and I'm like, hey, what about that property 123 Easy Street? He goes, oh, well, let me check on that because I'm not sure if it's still available. If he was the real wholesaler, he would know if it was still available. So a lot of those a lot of those dilettante wholesalers will advertise deals that they don't even have control over, and the reason they're not calling you back is because the deal's gone, or they think it's gone, or they're not that serious in the first place. This is another thing about belonging to DIG. If you go to the meetings and you will bother to network, you'll find out who the real wholesalers are. There's always people who don't have good deals, but everybody in the group knows who those are, and they will tell you, got to talk to people. You can't come to the meeting and sit in the seat looking at the front of the room until the speaker comes up. You got to go talk to people, and all of this kind of local information will come to you. Is it true that you might do a boot camp in May? If so, do you know what weekend that might be, trying to keep it open? Yes, I am doing a boot camp in May, and here's why. DIG is the 800-pound gorilla of real estate groups in this entire country. And when they say, if you're going to come to speak, you have to do a boot camp in our backyard, I do a boot camp in their backyard, even though I typically only do 2 a year, and this is number 3. The weekend is May the 18th through the 18th, 19th, 20th, 21st. So it's a Thursday, Friday, Saturday, and Sunday, so keep that weekend open. Is there a wholesaler site that these guys advertise properties on? No, there is. Well, there is. It's called Craigslist. Since at this time I'm only going to be assigning contracts to investor buyers, will part of my due diligence be learning how to do title searches? No, part of your due diligence will be finding a title company that can do title searches. Do not do your own title searches. You can order one without paying for it. It's paid for at the closing, and since you're not going to be at the closing, either the buyer or the seller will pay for it. I've heard that we can use the Google search, I want to sell my house in XX area, the list that comes up are wholesalers. Does that work for you? That's not true. The list that comes up is lead generating sites that sell leads primarily to wholesalers. So what's going to come up first is Homevestors, 1-800-CASH now. There's a bunch of these national companies that basically function as lead sellers, and they sell to local wholesalers. Usually like if you are the 1-800-CASH now franchisee in the Philadelphia market, you're the only one who's going to get those leads, but you won't be contacting the wholesaler by going to that site. You'll be contacting the national company by going to that site. Thanks, Vina and Don. Great information. Looking forward to March 30th. Me too. Can't the deals be listed in the DIG marketplace? I'm betting they can. That's another outlet for you if you want to list deals. All right, Don, I guess we have probably kept them long enough at this point. I think we said we were going to go an hour, and we are
that was a while ago.
past that point. I know.
We are indeed. Does anybody have any last questions for Vina? Okay, well, we've actually managed to keep almost everyone who joined at the beginning to the end. So hats off to you, Vina, for keeping our attention all of this time. Let's see, there's two more questions that have just come in. Let me pass them to you. That's one.
In the Philly market, is it best now to flip, wholesale, or buy to rent? Yes. Let the deal tell you what to do. Guys, basic lesson. You probably need to mute yourself, Don. I'm hearing myself twice through your phone there. Basic lesson that I hate to use the word advanced, but let's say experienced real estate entrepreneur knows that no newbie seems to know, is that your job is not to be a wholesaler or a landlord or a retailer or a lease option person. Your job is to be a deal finder. And now, please do not go get a college education in real estate before you do your first deal. Pick a strategy, learn about it, go do it, and do it, make some money, and then expand from there. Don't try and do everything all at once. That's a losing proposition. But as time goes by and you get more familiar with more strategies, what you will find yourself doing is only worrying about talking to motivated sellers, and the deal will tell you what to do with it. You know, the deal plus the market. I mean, there's some markets in which I would not have tried to retail a property in 2010. It was just really, really hard to find qualified buyers. But let the whole situation, the neighborhood, the condition of the property, whether or not the owner is willing to finance for you, whether or not he's willing to take a low-ball cash offer, tell you what to do with the property. That's the bottom line. And right now, any of those things that you're mentioning are perfectly good strategies if the deal tells you to do it. I have a house in the brewery town section, which is hot. I could have told you that based on the fact that it's brewery town. Do you know the best way to FSBO? Yeah, if you're trying to do a for sale by owner, put it in Craigslist, put a banner across the front of the house, and I'm not kidding, put a banner across the front of the house that says for sale, put some signs around in the neighborhood, and it should sell. Now, be prepared for the fact that there are a lot of agents wandering around with buyers who cannot find those buyers a deal. So you're going to get approached a lot by real estate agents who want you to list with them, and if you won't do that, they at least want you to co-op with them. So they want to bring a buyer to the table and have you pay them, and you should cooperate in that. Now, if you want to say, look, I'm not offering commission, so what you need to do is raise the price 3% to cover you, go ahead and do that. You're allowed to do that at least as a non-licensee. The best way to find wholesalers, I may have missed your answer, go to Dig. I mean, the wholesale deals, if you go on Craigslist and just look for, wholesalers advertise differently than other people do. So if you go to Craigslist and search for investor special, handyman special, almost all of those ads are going to be from wholesalers. And Don, I'm going to belay the answer to that last question until March the 30th, okay? The wholesalers that I know sell their deals within 1 to 2 days. That is accurate. My rule right now is if I have a property and it's still, or a deal, because I don't have properties, I have contracts, and it is still on the market 7 days later, I'm reevaluating what I did wrong, because the good deals go really fast, and that's why you need to react really fast when a wholesaler contacts you about a deal. And the market is not always going to be that way. In 2009, it took me 45 days to sell my deal. But I think this kind of tells you why maybe you want to be the wholesaler, or at least be in a position where you understand how they find their deals so that you can find them instead. All right, Don, let's wrap it up with that.
Yep, I think people have run out of questions. Vina, a virtual round of applause to you. Thank you from all of us. You were very kind to share your time and knowledge with us tonight, and we look forward to seeing you on April 8th, and the bit.ly link is still on the screen here, so everybody can use that. For everyone else, it'll take me 3 or 4, maybe 5 days to process this webinar video and get it posted up on the Dig website, and a notice will be sent out to everybody. So once again, Vina, thank you very much. Get some rest tonight. I know you've had a long day, and we'll see you in April. Thanks, everybody.
All right,
thanks for joining us tonight.
Thank you so much for your help, Don.
You're very welcome. Thank you, Vina. Thanks, everybody, for joining us tonight. I'm going to be signing off. Good night, everyone.